Hello and welcome to the channel. If you've ever heard the phrase "don't put all your eggs in one basket," you already understand the core principle of asset allocation. But for us investors, the real question is, what different baskets should we use, and how many eggs should go in each one? This isn't just some theoretical exercise. How you divide your money between different types of investments, a concept we call asset allocation, is the single most important decision you will make as an investor. Major studies have shown that over 90% of your investment returns over time can be explained by your asset allocation. That's right, over 90%. It's not about picking individual stocks or trying to time the market. So in this video, we're going to demystify this critical concept. We'll explain what asset allocation really means, show you how to find the right mix for your goals, and reveal the simple strategies that professionals use to maintain balance. Let's get started and build a portfolio that's truly built to last. Think of building your investment portfolio like you're baking a cake. You need different ingredients in the right proportions to get a delicious result. If you only use flour, you'll get a dense, tasteless brick. If you only use sugar, it'll be unbearably sweet and just fall apart. To get it right, you need a balanced recipe. In investing, our main ingredients are called asset classes. First, we have stocks, also known as equities. Think of these as the flour in our cake. They provide the structure and the growth potential for your portfolio. They are absolutely essential for long-term growth, but on their own, they can be volatile and risky, kind of like that plain flour. Next up, we have bonds or fixed income. These are like the sugar and butter in our recipe. They provide some sweetness in the form of steady income, and they add stability. They smooth out the texture of the portfolio and make it much more palatable, especially during tough times in the market. Finally, we have cash and cash equivalents. These are like the eggs. They bind everything together, providing liquidity and safety for emergencies or for when a great investment opportunity pops up. So, asset allocation is simply your investment recipe, the specific percentage of your portfolio you dedicate to each of these asset classes. But why is this so important? It's because different asset classes don't always move in sync. When the stock market is having a bad day and stocks are down, investors often run to the safety of government bonds, which pushes bond prices up. This negative correlation is like magic for your portfolio. It acts as a built-in shock absorber. By holding both stocks and bonds, you smooth out your overall returns, reducing the gut-wrenching volatility that causes so many people to panic and make costly mistakes. So, how do you find your perfect recipe? There is no one-size-fits-all answer. Your ideal asset allocation really depends on three personal factors. The first, and most important, is your time horizon. How many years do you have until you need to spend this money? If you're investing for the long term, say 20+ years for retirement, you have plenty of time to recover from market crashes. Your recipe can be heavy on stocks, which are the growth engine of your portfolio. An 80-20th or even a 90-10th stock-to-bond split might be appropriate for you. Now, if you're investing for the medium term, maybe 5 to 10 years to save for a house down payment, you need some growth, but you can't afford a major loss right before you need the money. In this case, a more balanced 60-40th or 50-50th split might be better. And for the short term, meaning less than 5 years, your primary goal is to preserve your capital. You can't risk it. Your portfolio should be mostly in bonds and cash. A 20-80th stock-to-bond split would be much safer. The second key factor is your risk tolerance. This is your emotional and financial ability to withstand market drops. You have to be brutally honest with yourself here. If seeing your portfolio decline by 30% would cause you to panic and sell everything, then you have a low risk tolerance and should have a higher allocation to bonds for more stability. But if you can see a market drop as a buying opportunity and stay the course without losing sleep, you have a high risk tolerance and can handle more stocks. And the third factor is your financial goals. What are you actually investing for? Building wealth over 40 years for retirement requires a very different strategy than generating income right now because you plan to retire next year. A simple rule of thumb to get you started is the 100 minus your age rule. For example, if you're 30 years old, this rule suggests you hold 70% in stocks and 30% in bonds. Nowadays, many financial experts use 110 or 120 minus your age to account for our longer life expectancies. But remember, this is just a starting point. You need to adjust it based on your personal risk tolerance and goals. Alright, so knowing your target allocation is one thing, but actually building and maintaining it is another. Let's walk through the simple, step-by-step process that the pros use. Step 1 is to choose your weapons. The good news is you don't need to pick individual stocks and bonds. The easiest and most effective way to implement any asset allocation is through low-cost, broad market ETFs or index funds. For your stock allocation, a great approach is to use a total US stock market ETF, like VTI, and a total international stock ETF, like VXUS. This gives you exposure to thousands of companies all around the world. For your bond allocation, you can use a total US bond market ETF, like BND. These simple tools give you instant, massive diversification. Step 2 is to build your model portfolio. Let us create a sample allocation for a hypothetical 35-year-old with a moderate risk tolerance and a long time horizon. We'll use the 110 minus age rule. So, 110 minus 35 equals 75. That means the total stock allocation should be 75%. We can split this between US and international stocks. For example, we could put 45% in a total US stock market ETF and 30% in a total international stock market ETF. The remaining 25% of the portfolio would go into our total bond allocation using a total US bond market ETF. This is your target. This is the recipe you will stick with. Now for step 3, the magic of rebalancing. Over time, your portfolio will naturally drift away from its target. If stocks have a great year, they might grow to become 85% of your portfolio instead of your target 75%. This unintentionally increases your risk beyond what you are comfortable with. Rebalancing is the simple process of selling what has done well and buying what has lagged to get back to your target allocation. This is a disciplined, automated way of selling high and buying low. You can rebalance on a schedule, say, annually or semi-annually. Just pick a specific date each year to check your portfolio and make adjustments. Another way is to rebalance when your allocation drifts by a set amount. For example, if any asset class moves more than 5% away from its target. But honestly, the simplest way for most beginners to rebalance is by using new contributions. Let's say your bonds are underweight compared to your target. You can just direct your next few monthly investments entirely into your bond fund until you reback on target. This is a great method because it avoids selling your winners and potentially triggering taxes. So, let's do a quick recap. What is asset allocation? It's your investment recipe, the strategic division of your portfolio between stocks, bonds, and cash. Why does it matter so much? Because it is the primary driver of your returns and risk, acting as a shock absorber during market volatility. And how do you implement it? You determine your mix based on your time horizon, risk tolerance, and goals. Then you use low-cost ETFs to build it, and you rebalance periodically to maintain it. Asset allocation isn't about finding the best investment of the year. It's about building the right portfolio for you for the long haul. It's the framework that allows you to sleep well at night, even when the market is turbulent, because you know your portfolio is designed to handle it. So, stop focusing on picking the next winning stock. Start focusing on building your winning portfolio. That is how the pros truly balance risk and return to achieve their financial goals. Thank you so much for watching. If you found this helpful, please hit that like button and consider subscribing for more content to help you on your investment journey. See you in the next video.